Welcome to the podcast series, You've Been Granted, hosted by Brian McDonald, CEO and founder of Granted. Today's guest is Bernard Tong, Vice President and Senior Financial Consultant at Charles Schwab. We hope that you enjoy this conversation. And now, Brian, over to you.
Hello, Bernard. How are you today?
I'm well, Brian. How are you?
Great. I've been looking forward to this conversation. You're one of the best in the business. I continue to hear from my colleagues around the stock plan space about how you've gotten involved to help many of the participants at their companies, delivering not only expert advice around equity compensation, but just ongoing help and guidance as it relates to their broader investment portfolio and their financial lives, really. So I've been looking forward to this conversation.
Well, it's really kind of you to say. Thanks for having me on.
So we got a chance to get to know each other a little bit along the way. And of course, I spent 25 years of my career at Charles Schwab and Company, where you are now. Maybe not in the same office. You guys have moved around in San Francisco a little bit. And now you have the Westlake headquarters. Still have the large campus here in Lone Tree. But maybe for our listeners, why don't you give a little bit about your background and experience, and how did you get from A to B to now Z, where you are today?
Yeah, I don't think we have enough time, right? No, but yeah, I've been with Schwab and I think Fidelity for the majority of kind of almost 2 decades in the industry as an advisor. But originally came here to the West Coast in San Francisco from Boston, and just really got interested just from being in Silicon Valley. And frankly, meeting the people that actually make an impact, on our lives through technology and the things that we use on so many different levels, right? So, I'll say I still remember early in my career, I was in Palo Alto on University Avenue when Facebook went public, and that always resonates because, of course, it's Facebook, but it really piqued my interest around equity and what a technology company like that can do, not just for consumers, but for individuals and their families.
Yeah, for sure. I think even I remember once I had a chance to meet with Chuck Schwab, and he was talking about equity comp and said it's the single largest source of how wealth is being created in America today, beyond kind of just raw, I guess, entrepreneurship. But even then, when there's an equity plan involved, it's exponential in terms of what it can do. And then also, when you think about it, everyone talks about your 401k, but really equity comp has a chance to be multiples of maybe what your 401k savings is after many, many years of putting in the max. So you've seen that firsthand. Especially if you're talking about companies like Facebook, now Meta, and of course you live in San Francisco, not necessarily in Silicon Valley, but minutes away. And I know you go up and down the peninsula anyway. So hotbed of innovation, and certainly equity comp is the currency to attract and retain top talent. Yeah,
and then of course there's a little thing called AI right now. So I don't know if you're familiar. But
I've heard of it, yeah.
San Francisco really is the hotbed. It's amazing.
Yeah, so. Some of the multiples that we're seeing on some of these private companies are tremendous, and never did we think, probably when we first started our careers. And by the way, you're quite a bit younger than I am, but even when you started your career in this space, never did we think. I'm sure that the valuation of private companies would be, significantly greater than many of the public companies that have been around and kind of the growth engine for so many years. But super interesting to see.
Yeah, absolutely.
So as I think about what you just said and where you've been, Fidelity, now Schwab, and some other stops in there, you've been with some of the largest companies in financial services, and two of the top record keepers when it comes to equity compensation. So what are some of the things that you see especially working with tech executives? What are some of the biggest mistakes that you see them make along the way? What's the pattern recognition there?
I would say that the first thing that comes to mind is looking at equity, not exactly the right way, as odd as that sounds, right? Because it really should be it is income first, right? Income first, and an investment second, right? And some folks even look at it almost like a lottery ticket. And I actually have a really personal story. One of my good friends, 10 years ago, just kind of met me at my old firm, and um, her wedding was right around the corner. And we just looked up her information, and she didn't realize that she had $35,000 in company stock from her old employer. So I think
one that she wasn't even working at now.
Yeah. So it was. I mean, this is 10 years ago. So this is a job that I think there are ESPP shares that she completely forgot about. And to this day, we kind of joke about how it certainly helped pay for the wedding. Again, this is back in 2015, 14, dating myself. But I think that's a good example. This is real money. It's not the lottery.
Okay.
And it really does have the impact to help you to help you and your family just kind of get to where you need to be, right? So really, they look at it. They really should be looking at it as income first and investment second.
That makes sense to me. We talk all the time about Granted, about how concentration risk is real, and even some of the surveys that Schwab has done recently. I think they did one last fall where they talked about 29% of people who have equity comp understand how it fits in their portfolio. 44% when you use an advisor understand how it fits. The question we're trying to help solve is why isn't that 100% when you're using an advisor? But it just shows the complexity. And I think what happens, I'd love your opinion on this. I think what happens a lot of times is that individuals are afraid to make a mistake, and so they do nothing. And I guess if everything is up and to the right, maybe you can say that's a good strategy. But to your point around its income, if your salary is from there, your bonus is from your company, and then all of a sudden it's 75% of your overall net worth or portfolio, that could be a real risk. And so, how do you think about that?
Well, you really need I would say two things, right? First, lead with education, right? It's as common and as I have so many clients that have had RSUs for a very long time, and they'll finally get to the point where they start wanting to diversify in the most tax efficient way. And when we remind them that RSUs, there's no difference in taxation whether you keep the stock or sell it upon vesting. You're still getting income, right? And just selling it upon vesting is the most effective way to sell anything in the future and diversify. There's to this day, Brian, there's a light bulb, right? And I'm talking senior directors, even executives at times, that they don't register. Right. And then secondly, I'll say you really need to make sure you identify what the purpose of the money is.
Yeah.
Right. And have a really holistic view. I think it's extremely true that a goal without a plan is a wish. And not having a plan is kind of planning to fail. And that could not be even more true with equity compensation because of how it works, how volatile the stock can be. But essentially, we're sitting down, looking at the big picture, and saying to the McDonald family, right?
Yeah.
How do we Brian McDonald your money in the future, despite being bullish or bearish on your equity?
Yeah, that makes sense. And it is complex, and not only RSUs, more and more plans are RSU only. Although some of the regulation changes are shifting back, and you're starting to see options come back in favor. Seeing a ton of performance stock units, and for obvious reasons, I think that makes a ton of sense. But those become very opaque. Sometimes you can't track the targets. It gets really complicated really quickly. but certainly something that puts a lot of complexity into our business and therefore your business when it comes to advising on clients. And we talk about tax planning a lot, but when we think about tax planning with regard to equity compensation, you hear things about ISOs versus non-quals or AMT and QSBS. Again, it gets to be alphabet soup pretty quickly. What's one thing that you wish every employee kind of understood before they made their first move when it comes to taxes and some of those instruments?
Yeah, that's a great question. So when it comes to tax planning and your equity compensation, I think everyone, before they make any decision, despite the type of equity or it is, whether it's an incentive, non-qual, QSBS, what have you, before you touch anything, you want to ask yourself, what event triggers tax, right? Is it at vesting, like an RSU? Is it at exercise, like a non-qual, or is it at the sale, like an incentive stock option, right? That one question, I think, if you ask yourself before making any decisions, will prevent a lot of really expensive surprises in the future.
When you say ask that question, I guess you joked about AI earlier, but it is beginning to, I don't want to say level the playing field. It's beginning to help individuals and advisors to bring information to the surface. Hopefully that information is the right information. We talk a lot or joke a lot about hallucination, but obviously things are getting better and better every day. Of course, Granted is AI native from the start. I mean, we're using our knowledge base. One of our partners that we work with, My Stock Options, their knowledge base, and really bringing those insights and answers to life based on proven information and certainly tested calculations, et cetera. But when you say like they should ask themselves the question of what triggers tax here and how does it affect me? I think that's part of the challenge. Do you suggest they come to you, like the financial advisor, their CPA, go back to their stock plan administrator? But who do you suggest that they ask those questions to?
Yeah, I come to a financial advisor that understands equity compensation or a CPA, a professional that actually understands it. Whether you're a financial advisor or a tax professional, not all tax professionals and advisors actually have a full comprehension of equity compensation.
I'm assuming that's why that stat in the survey was 44% of people with an advisor understand their equity comp. It's because in some cases, their advisor may not understand at all, right? Like,
right.
Not all advisors are created equal, I guess.
Yeah, and CPAs too. It's amazing, kind of what we've seen and what I've seen in my career, and the amendments that clients have made to save easily upwards of over six figures from not reporting, QSBS or not accelerating ISO credits or what have you, AMT credits, but making sure that you surround yourself with the right team. And I think a lot of this, as we talk about AI, there's just a tremendous opportunity for it to simplify things as it analyzes specifics of someone's grants and knowing what they do know about that individual. And I think it could be or is a great tool for us to, what I like to, how I describe to newer advisors when talking to clients, speak English, right? If you don't understand something simply, oftentimes you don't understand it. But I think making sure that you can effectively communicate that and use AI to see how that impacts your personal situation.
Yeah. What about, so again, I mentioned concentrated positions earlier. We talked about how that can happen and, trying to make those decisions, RSUs obviously being ordinary income and, so selling right away, obviously there's no cost basis at that point. So you don't have to worry about taxes. That's already been kind of factored as part of either the withholding or something you brought together. But with concentrated positions, not the tax position alone, but the emotional part of it, right? We talked about your you're loyal to your company, you believe in the stock, hopefully it's performing well, but how do you approach a client who's so deeply attached to holding their company stock that they're really putting themselves at risk? And then, what kind of tools do you use to kind of help them see that more vividly?
Yeah. Frankly, Brian, I don't try to talk them out of loyalty, to be clear. I do try to see where it fits into their overall goals, their overall situation, because it's oftentimes, especially for the clients that I work with, their family's primary source of wealth, right? And through that dialogue, I've said this more than one time. It's like, hey, Brian, would you rather have company stock or a new house, or would you rather have company stock or education funds for your two kids? So it really is about uncovering the purpose, right? And asking that question: what is the purpose of this money? Is it education, a home, a foundation for the future to be work optional sooner? And if so, if we do A, B, and C, then this will be the output. Now, I'll say one other thing. Probably as an advisor, I shouldn't tout this too much, but I actually, depending on the stock, right, and the client situation, having concentration and being loyal to a good company isn't the end of the world, right? They might be at critical mass or have plenty saved at this point. And having concentration, again, presuming it's not a penny stock or something overly volatile or not in their best interest, right? But the big tech names, I don't think they're going anywhere long term, at least in the short term. Who knows? What's not overrated, and I always say this, is having a plan around it. You need to have guardrails, right? So that will change over time, such as your financial plan is always a point in time kind of assessment. And as things change in your situation with your goals and your wealth, so might your perspectives, right? I've had plenty of clients in 3 to 5 years be really bullish on a stock. And then to my surprise, in the first quarter of the following year, they're ready. They're ready to say, okay, how much can I sell so I can keep as much as possible in order, to be work optional in 5 years, right? So it really is not about trying to talk anyone out of anything. It's about getting an understanding of their situation, what's the purpose, what are their goals, and talking them through it.
Yeah, that makes sense, and well said. Like, not your job, I guess, necessarily to talk them out of holding company stock, but trying to understand what their goals are and how to best go about optimizing toward those goals. I think that's a big part of what an advisor does, and sometimes that means holding up the mirror, and sometimes it means just really asking the right questions to help them arrive at the answers on their own. Quite frankly. So I noticed, as I was checking you out, you had a couple things going on. CFP, which I think everybody knows what CFP is, Certified Financial Planner, and an important designation as you think about helping your clients and prospects. But the other 3 letters, the CWS, is less well known. So Certified Wealth Strategist, it's a little bit different. How do those 2 things come together for you, and why was it important for you to have that CWS designation?
Yeah, I think that the CWS is the Certified Wealth Strategist designation is just another layer of more to get a better understanding of comprehensive wealth management, where it pertains and really integrates with not just your investments, but the big picture: taxes, estate planning, gifting, charitable intent, and also how that ties to how you feel about money, right? There's a lot of qualitative things that we learn, but this is all to be able to help a client and their family better, right? And I think that is so critical and important when it comes to equity compensation, because it touches everything. It's kind of the foundation of their wealth, right? And of everything else it touches in regards to the taxes and risk, and then it can also lead to different decisions with gifting. Right. Being aware of what the best way is to be charitably intent, or to help individuals, like family members. The certified wealth strategist has been a nice addition to the alphabet soup, as we say, and the CFP, just to have that knowledge, to be aware of what to look for when working with with the clients that we do.
Yeah, makes good sense, and I think probably gives you some insight to some things that your clients really care about, and maybe helps you even bring up some things that the normal client advisor relationship wouldn't bring about or wouldn't think about.
Yeah, and I'll say this: I see it firsthand, especially with folks in the prime of their accumulation years and the busiest years of their life with their growing family and buying a bigger home. I think time is the most valuable asset, and when you reach a certain amount of wealth, there's just more complexities, right? It's kind of a champagne first world problem, but again, seeing it firsthand, there are plenty of folks that can do it they can kind of manage it themselves, or with some help, a CPA here, and a state attorney here. But having a coordinated effort, right, where the left arm is talking to the right arm through an IPO or through a tender, or with the client, and having a team cohesively has always frankly resulted in more optimal outcomes. So having a cohesive team of professionals and specialists to help you when things grow and your wealth grows with your equity is I can speak more of it.
Yeah, I mean, I've been in this industry for 32 years. You've had a chance to lead large workplace businesses at Morgan Stanley and Schwab, but we have a tax attorney who's a specialist in equity comp on the team at Granted, and I go to him often for questions because, again, it gets the more complex, the better I think he is, and obviously it's validating versus just using an online resource. So sometimes having a professional that's kind of seen it and lived it can really go a long way. So I'm sure you get that with what you're doing and having the CWS and the CFP. Let's switch to Schwab a little bit. Again, one of the most well-known brands in the industry. Through organic growth and acquisitions, you've built one of the largest retail wealth management firms in the industry. I think 35 million clients or something like that right now, or something enormous. But you also have a large equity compensation or stock plan infrastructure. I know you have some of the largest plans in the country, and obviously that gives you guys kind of a seat at the table to help in this equity comp space, both from a service and admin, but also from a planning standpoint. But as you look at kind of what you guys have done in the industry and what you see across the industry landscape, where are there gaps today in terms of really being able to either help the participant with their equity comp, or help the advisor help the participant with their equity compensation?
Well, Brian, I'm glad you asked, because there are no gaps at Schwab at all, actually. No, I'm kidding. No, I think really there's levels to this, but the first leads with resources, and I think that's personalized resources for the employee base. Simplify. There's so much. There's onboarding. There's excitement with a new company. There's establishing accounts, but offering the employee, a one-on-one to make sure that they're prepared, right, and that where they can talk to someone and get personalized guidance and help, because not everyone's different. Some folks already have accounts. Some folks know how things work, right? I would say Schwab is always making advances in technology and trying to make it a better experience. So for a lot of folks, we're seeing a lot of automatic or electronic 10b5-1 processing, which allows automated selling for employees that are subject to Windows, and I think that's a great advance. But I think there could be work there as well. And then the planning and how that's coordinated. Yes, we are here. We kind of do everything at Schwab, A to Z, wherever you are in your journey. But when you get to the more complexities, making it easier to do business and identifying kind of the type of help that folks might want, and that can come from both the company and also the stock plan provider, right? So we do our best here, but I do think there's a bit of a gap with as it pertains to equity, maybe not so much the analysis, but the specific and prescriptive guidance in tracking of how they're incorporating everything together.
Yeah. Well, certainly the mission at Granted, we felt like a lot of the holistic planning tools really just didn't get below the surface like you need to on equity compensation. So that's why we tried to build a set of tools for both the advisor and now the issuer and the participants directly to help them not only better understand their equity compensation, but also better plan, understand, if I want to exercise up to the AMT, where that gets triggered, how do I stay under it? If I have, upcoming liquidity needs, how do I think about that? How do I plan for it? How do I do it in a tax optimized way? Again, I think that's where we like to partner with both the professional like you at Schwab, and then also with the individuals at the companies that you're supporting.
Yeah, and our clients, a lot of our clients are engineers. They're all educated. They're, the clients that we work with, they're pretty smart, and having those tools, right? It's almost taboo, or is becoming less taboo, but we all know, thresholds, right? There's internal revenue code.
Yeah.
But sometimes people are too often concerned to say the obvious, right? So having something to gap the tax planning needs, right? You nailed it. I mean, why don't we have something that where someone can input their variables to get a personalized estimate, guidance, not advice, of AMT tax liability or potential credits in the future if they are willing to input the variables. And another one is, we know their RSU income, right? We have a good understanding of what's vesting, during vest dates throughout the calendar year. I see under withholding, right, and getting penalized for the IRS. That's really annoying, right? So it just adds another call, or even if someone's not sure, as those dollars increase, that 1, 2, 3, 4, 5% can really add up from under withholding and getting penalized from the IRS. So having those tools available that are more personalized.
Yeah, for sure. I think under withholding is real. See it every year. I hear people complain about. Again, maybe these are first class problems, about the big tax checks they have to write, but not understanding why, because feeling like the company withheld the shares to cover the taxes. But oftentimes, if that's the statutory minimums, it's below what their true tax rate is. So absolutely an issue. And then you're right. I mean, with the Tax Cut Jobs Act, TCJA, we're seeing less AMT than we used to. But we might be seeing it more because more private companies are staying private for longer. And if you think about ISOs, that's where it starts to show up quite a bit. But why don't we pivot a little bit? I mean, we've talked about equity comp overall, but maybe a little more in the context of public companies. But when you think about private companies, are you open for business for private company employees? Do you help them with their liquidity needs or planning on their equity comp, and whether secondary makes sense or 409A valuations? How do you approach private company clients?
We do. I think there's twofold, right? One question that we receive often is how do I negotiate a package, right? What are some things to be aware of? And in regards to the equity package, when they leave a public company to take a risk with even a well-known private company. So we'll provide the questions to ask and be aware of. Some simple things that, for folks that have gone through an IPO, asking for a longer expiration on stock options after they've left. But simply by asking, they could potentially get that in their package. Or is there an early exercise provision for tax purposes? But little nuances there, right, on the package itself. We certainly help founders and folks that are getting tender offers, especially in San Francisco right now, right? Tax withholding, asking if it's eligible for QSBS if they are founders and depending on the stage, but really having that knowledge of asking the right questions that are kind of right there in front of them that they don't know to ask, that could frankly save millions of dollars in taxes in situations we've seen from simply restructuring or getting the information needed. So with private companies, there's a lot of strategic and tactful things that you should really be aware of from working with, at a private company. But we're right now, recently, the bigger companies we're seeing, there's a big discrepancy between, the most recent preferred pricing and the secondary price, right? So a lot of that is more that conversation of how much do I take off the table, can really come down to just personalized planning, right? So they can have the information they need to make comfortable decisions.
Yeah, that makes sense. And, you guys have made some moves in the private market space, and I saw the partnership you launched with Capita on the cap table side. The acquisition of Forge obviously was a really big deal. And with private companies staying private for longer, I think it's 12 to 14 years on average. The other thing I always like to say, and we should talk about this a lot, is that just because somebody it works for a private company and doesn't have liquidity today doesn't mean that they don't have concerns, planning needs, and quite frankly, doesn't mean that they don't have wealth. In some of these cases, it might be their third or fourth exit that they're working towards, and so their planning needs are the same as anyone at a public company, and sometimes maybe even more complex as it relates to the rest of their wealth.
Yeah, I can agree with that more.
When you think about overall, you mentioned it earlier, some advisors are, have built their practice around equity compensation. Some of them, like you, maybe it's not your entire focus, but it's a large part of what you see every day, mainly because the opportunities all around you to help clients are clients who are working for these large public and private companies where they have equity compensation. But what's one thing that you think that would really kind of raise the bar or raise the game for the advisory community to understand, better how to serve these complex equity compensation situations?
Things need to be personalized, right? There's a lot of kind of tying back to some of the examples we've already discussed on this podcast. Everything should be personalized, right? I mean, it starts with clients' goals, but I think preferences shouldn't be overlooked. Yeah. So, whether it's the thoughts and the decisions that they make around their stock, based off how they feel about it, right? And then I would say there needs to be more planning. Yeah. Okay, kind of coming back to that, right? Through the kind of the dialogue and asking the right questions and understanding the client situation, right? It makes decisions so much easier, right? And having the resources and knowledge to do that. So, I think back to kind of where I am in San Francisco, being down in Palo Alto for a few years and in Sunnyvale for several years at my other company. It's equities in your face, so it's
all around you.
You just
can't hide from it.
You'd be kind of foolish not to understand it, right? In my role, but it's amazing how gratifying it is to kind of help hear from a client, say, okay, this is great. You helped us, you gave us the confidence to have another child or get this house or get a vacation property. Right. And that is all done through personalized planning around equity compensation. So I would say, whether it's tax guidance, investment management, it needs to be personalized. And then it should be led with planning and getting an understanding what's in the client's best interest.
Got it. So I love that. And roll it forward for me just a little bit. Like, when you think about financial education for the employees, not the advisors, but the employees, when they get their first grant letter, like what would that look like in an ideal world for you? What would you want the employee to learn or know, or what would that program look like?
Ideally, it would be a one-pager, right? I kind of put myself in that seat, and quite often it
Keep
is.
it simple. Yeah.
Yeah, keep it simple, right? What's most time sensitive, right? Of course, have hyperlinks, but maybe even going back to giving direction about where the resources are. Before it was always one-on-ones. Now we have technology. So what can they use to ask additional questions? But really keeping a one-pager with here's what you need to do by now, and then kind of not too many like really important resources that can kind of where you can go and ask questions and get answers. I think AI is going to solve for a lot of that efficiency from a UI, just keeping it concise and guiding them to the right place, right? But less is more quite often. One of my biggest pet peeves is always hearing kind of what's around the corner, right?
Yeah.
That's going to be released Q5, right?
Yeah.
Well, tell me when it's released, right? So what's important now and keeping it simple.
Yeah, love that. And since you mentioned how things are evolving and changing, that's my last question for you. Really, is with AI, not the stocks and not the companies, but the output. Is the last 90 days has been amazing, and the 90 days before that was amazing. So it's continued to move faster. Maybe towards AGI or whatever you want to call it, and the tools are getting better and better. But that, as well as constant changes at the SEC with Rule 10b5-1 or other things going on, like where do you see this industry going over the next 3 to 5 years, and maybe what are you most excited about?
Better experiences. I think AI is going to be great. We're going to, it might replace a few things, but for the most part, we're going to work with it. You think of robo-advisors back in 2015, and the headline was, there's no more financial advisors.
Putting advisors out of business, right? Yeah.
Right. Last year was the lowest adoption, 11 years into it, right? Or 10 years later. And I think that the only constant in life is change. Right. But with AI specifically, especially as we talk about equity compensation or financial planning or nuances between working with a private company or a founder or startup, AI is just going to make the experience a lot better. So, folks like myself can have much more meaningful discussions with Brian and his family about what to do and what's important, right? So I really am excited about it. I think there's just endless possibility to kind of decipher the nuances of the tax code, but also really give some more personalized anecdotes and summaries for us to
love that
discussions.
Yeah, I love that, and that's why at Granted we built the advisor platform first, because we still believe advice is highly personal, and money is emotional, and having that human in the loop we believe is still incredibly important. Who knows where we'll be in 10 years, but for me, like, my bet is still on the advisor being such an important part of the advice conversation, and I think AI for our industry will be there to enable the advisor to give them greater efficiency and be able to spend more time face to face with their clients.
Yeah, and I think the clients that I work with that are a lot of them are extremely well off. They still want to talk to someone.
Yeah.
Right. So having efficiencies and better discussions will also lead to lower costs.
Yeah.
Right. To have those discussions. So there's going to hopefully be it's going to be a more optimal outcome. But just because AI is around, it doesn't mean that I don't want to talk to you, Brian, about something after I research it.
Yeah.
So I think that's even more critical than ever now, because as we get beat over the head with what's new in AI.
Completely agree. All right. So last question I have, I guess, Bernard, for you today is, less about equity comp. You talked about working with a lot of busy professionals earlier. You're one yourself. I I think you spend a lot of your time chasing around a 2 and a 1-year-old. Maybe I'm getting that right, but
close. Yeah.
a young family. What is one thing that you're really looking forward to this summer? And what does Bernard do to keep himself sane? What do you like to do individually?
Yeah, individually, I wish I could remember because we do have a 3 and 1-year-old.
You are at that stage, yeah.
Yeah, but it's fun and we embrace it. With my family being on the East Coast, but we'll travel again to Alaska. I think my wife and I remember we tried to travel as often as we could, knowing that we're trying to have kids, right? So that'll be a fun family reunion. But really embracing the time now that we have. Hearing from other folks like yourself with older kids, it doesn't last forever, and really enjoying as much of it as we can, right? Yeah. So it's thanks for asking, but it should be fun. Even though my father said you've seen one iceberg, you've seen them all in Alaska. So we'll see.
I still haven't been. It's on my bucket list. I need to get there. But I certainly understand, and someone with older kids, I would say, they're physically exhausting when they're 3 and 1. They get emotionally exhausting when they get to the teenage years, and when they get to be adults. As much as I was thinking, I don't want to age, so I don't want them to become adults. They become pretty fun. Like, it's really good to have conversations, deliver real advice that they can act on, and quite frankly, learn from them. So I learn from my kids every day. So it's definitely a journey. I'm glad you're on it, but Alaska with the kids this summer sounds awesome. So hope you have a lot of fun with that.
You too, and I'll take any unsolicited parenting advice from seasoned parents, right? It's the unsolicited advice from non-parents that isn't really welcome. So thanks for sharing that, Brian.
It's like everything else, right? You ask 3 people and triangulate to the answer you like the best. But certainly great to spend time with you, Bernard. Again, one of the best in the industry. Grateful for you taking the time to be with us, and lots of success for you and your family, and certainly for your clients. But thank you for being on the Ask Granted podcast today.
Oh, thanks for having me. And I'll say that from what I've seen with Granted and the tools, it's exciting, it's interesting, and we need it. So I know the adoption is happening fast, and it could really make an impact. So I'm excited to see it more. And thanks for having me on.
Yeah, for sure. Yeah, but better outcomes for clients, right? That's what we're all focused on.
And advisors, right? And experiences. So, yeah. All right, Brian, thank you much.
All right, Bernard. Have a great day.
You too.
Thank you for joining us on this episode. We hope you enjoyed Brian and Bernard's conversation. Be sure to tune in to our next episode of You've Been Granted. And please stay connected with us on LinkedIn and YouTube for updates on past and upcoming episodes.